Hello, ladies and gentlemen. So, this is your teacher Usman Ali, and the video is regarding the adjustments of the irregular items. Now, you have got the concept that what actually irregular item means, for the income statement or retained earning statements actually from the PPT recordings of mine. So, you do have a concept that understanding of that the all of these irregular items actually. Now this video focuses on that, okay, we do know what they mean, but how we gonna adjust them, how we gonna account them in our books of accounts actually. So the video is actually for that purpose. So the we had, as you know, that we had 6 special income statement items or irregular items actually. Now the first one is the discontinued operation. Now the F.S means financial statement, and tax means what would be the tax consideration with the discontinued operations actually, and others as well. So whenever you see an item or an account related to the discontinued operations actually, so you will adjust that item in the income statement of the company, okay? And the type of adjustment that you're going to do, or the tax consideration for that, would be net of tax, which means after the deduction of tax, net of tax. Okay, so remember this thing. So whatever the amount of loss is given, we must subtract the tax out of it, and then we will do the adjustment. So you would learn this thing when I do the numericals in other videos. You're going to learn these things, that okay, yeah, so what does actually the net of tax actually means here. But what you need to remember is income statement. Okay, then if you talk about the extraordinary items, so extraordinary items are also adjusted inside the income statement of the company, and their adjustment is also net of tax, means after the deduction of the tax. Okay, the third irregular item we have is the unusual or the infrequent item. This item is also adjusted inside the income statement, but the tax consideration of this item is pre-tax, which means we are not gonna subtract the tax amount from this. Whatever the dollar money is, if it is a gain or a loss, if it is a plus or a minus, we are not gonna subtract any tax percentage out of it. Okay, pre-tax means this thing. Then change in estimate. So change in estimate here will also be adjusted inside the income statement, and the adjustment we gonna use for the tax is the pre-tax, means no deduction of the tax will be done. Okay, the fifth one we have is the errors and omission. Error and omission items are actually adjusted in the retained earnings statement. Okay, and so we will learn what actually retained earnings statement is, because in fact we're gonna have numericals on all of them, so I will be brief here. And the type of a tax related consideration is net of tax, means after the subtraction of tax, just like here. Okay, change in accounting principle, the last one, it is adjusted in the retained earnings statement, and its adjustment is also net of tax. So net of tax means we will subtract the tax first, and then we're gonna adjust it. Pre-tax means no, we are not gonna subtract any tax, we will directly adjust it into its required place. So let's see the adjustment of each one of them one by one. Okay, so let's go to the first one. Let's see how the discontinued operations are adjusted. Now if you see here, as you have understanding of this basic structure of the income statement, so I've already prepared it to save your time and MBs actually. We, in any income statement, the name of the company, income statement is written for the year ended 2000, whatever it is. Then you write sales. From the sales you subtract cost of goods sold. The remainder is actually called as gross profit. Then you subtract expenses, operating expenses like selling expenses, admin expenses, and other expenses could also be here. So the total of the expenses are subtracted from the gross profit. The remainder is actually called as earning before interest and tax, or you can also call this operating income too. Okay, then we have the other section. Other section represent here non-operating revenues and non-operating expenses. Okay, so rental revenue is a non-operating revenue. I'm gonna add that with the EBIT. Interest expense, minus it from the EBIT. The remainder of this is called earning before tax, which we generally call it as EBT. then we subtract the tax expense, and whatever is the left, okay, left figure or left over, we call it as net income. But ladies and gentlemen, remember this one point now, that whenever you see the word of discontinued operation in a numerical or in a real life, you will follow the same format. You will come step by step. But when you arrive to the last figure of net income, then the last figure cannot be called as net income. I just wrote it for revision purposes, and right now assume that I am rubbing it, okay? So you cannot write, or you cannot name this figure as the net income. Why you cannot name it? Because we have a discontinued transaction or a discontinued information is available in the question. So then what do we call this figure? We would call it or name it as income from continuing operation, or you can say income before discontinued operations adjustment, okay? So I can write here income before discontinued operations. Sorry, oh, again the line issue is there, really sorry for that. So income before discontinued operation adjustment. It means that this is the income, okay, of the company, but actually from this income we have not made any adjustment of discontinued till now. After this I'm gonna do the adjustment. Is it okay? So that's actually the point here. And after this, then you will write here. If it is a loss, you're gonna minus that. And if there is a gain because of discontinued operation, you're gonna plus it then, okay? So let's say we have a loss. So I will write here minus loss from discontinued. So I will like go for shortcut to save your time. Loss for discontinued operation, okay? Let's say the loss we had is $1 lakh. This is our loss, okay? Now it is a loss. What we're gonna do here is, if you remember, right now we are working in the income statement, but the tax adjustment is net of tax, means the tax must be subtracted out of it. It is that in good times when the government take tax from us, in bad times they help us as well. So I will write here tax adjustment. And let's say now in our country the tax percentage is 20% of the business income. So this is a loss actually, but again 20% will be applied. So 20% of 1 lakh will be $20,000. And the remainder value, loss value, will be written here, 80,000. 1 lakh minus 20 is equal to 80. Why I'm writing this in minus? Because this is a loss. Is it okay? So what does it mean? Okay, what does this $20,000 means then? Look at this. If let's say my tax expense for this year here is $60,000, okay, I must pay $60,000 to the government. So what I will do is that I would say, okay, 60,000 minus 20,000, remaining 40,000 I will pay actually to the government, that please take it because of the $20,000 tax adjustment. Is it okay? So this value minus 80,000, whatever the remainder would be, that actually would be then eventually called as the net income. Is it okay? So I hope you got the point. I would just highlight this portion for you so that you can remember it, that this is our adjusted area. So this highlighted portion is the place where we will always adjust if we have any discontinued operations present in our organization actually. Okay, I hope you got the point related to the discontinued operation. Let's continue and let's talk about the the next item, which is extraordinary item. So in order to save time, I have prepared the same income statement: sales minus CGS, gross profit minus expenses, EBITs, more expenses, EBT, tax is equal to net income. Same thing, everything is same, okay? And if you see here, extraordinary item are adjusted in income statement. So this is an income statement. and they will be also adjusted net of tax just like discontinued operations. So we're gonna have the same technique here. Now as we have extraordinary item present in the company, so we cannot use net income figure here, or sorry, the name here. This figure would be actually called as income before extraordinary item adjustment, which means that I have not done any extraordinary adjustment yet, and this is the income at this point in time. Then if it is a loss, I'm gonna minus it. If it is a plus, I'm gonna plus it. Okay, so let's say that we had a loss right now, so I will write here loss from extraordinary item. Okay, what is the amount of loss? Let's say, again, to make my example simple, it is a $1 lakh loss, and then again I'm gonna do the tax adjustment here. So in our country the tax percentage is 20%, so it's like $20,000 would be adjusted. The remaining $80,000 will be subtracted actually, because it is a loss, so I'm gonna subtract them, and the remainder that we get would be actually called as the net income. So if you see here, I did followed the same process of discontinued operation, only with these change wordings of extraordinary item. Okay. Okay, so if you see here, I have highlighted it actually the same place. So this is the area where I had to adjust the extraordinary item. So remember this thing for discontinued operation and extraordinary item, that both of the adjustments will be done inside an income statement, and the adjustments will be done after the net income place actually, because till here you have studied, okay, from like here till here you have studied in your basic accounting, and this portion is actually then your intermediate accounting area. So you're gonna adjust that here, and this name of net income, instead of naming it to this figure, we will shift it to the bottom, and we will shift it here. So actually the income statement and extraordinary items, both of them are adjusted same actually. So let's see a scenario in which I had to adjust not one of them individually. Let's see what if there is an organization, and that organization has both kind of transactions available. Discontinued operation is also available, and extraordinary item is also available there. So let's see how this will be adjusted then. So again, the same format of income statement. Okay, there is nothing changed, so I cannot name the last income figure as net income, because we had discontinued and extraordinary item available. Now as we have both of them available in this numerical now, so what we will do is I will write here income before discontinued and extraordinary item adjustment. So here I have written both of the names here. Okay, sorry, adjustment. Okay, I'm not gonna just write income before discontinued operation okay adjustment. No, income before discontinued operation and extraordinary item adjustment, both names will be used here because both of them are in this. And then first I will adjust the discontinued, and then I will adjust the extraordinary like this. First I will write here loss from, so in shortcut I am writing, sorry for that, discontinued operation. Okay, I just want to save some time, so for your MBs, okay, that's like this. And then I will go for tax adjustment. So the tax adjustment, 20% of this is $20,000. Okay, so what I will do, I will write here $80,000. I subtract it, I get a remainder here. So this would be now called, now if you can see here both of the discontinued and extraordinary was not adjusted. But now at this point, one thing is adjusted, which is discontinued is gone. It is adjusted actually. So this time I'm going to write here income before extraordinary item adjustment. Okay, so if you see, I deleted one name discontinued from here because it is already adjusted here. Okay, and after this I will write here minus loss from extraordinary item, which is, let's say, 1 lakh, and then again I will write here tax adjustment 20,000. Okay, and again 80,000. So don't get confused because of the same values I'm using it because it's easy to calculate without any calculator, that's why. So you subtract 80 from this, you get a remainder value, and this remainder value will actually be called as the net income. So this is how you will adjust if both of the transactions or items are actually available for you people. Okay, so I have highlighted the area for you. So this would be the adjustment of discontinued operation, and this will be the adjustment of the extraordinary item actually. So this is a scenario where both of the adjustments can be made within like 1 year or the same year income statement here. Okay, previously we had like this one was individually for discontinued, and this one was actually for the extraordinary item, and now we have this one where we have actually adjusted both of them. Okay, so the first two adjustments are done actually, which was the discontinued and extraordinary. Let's go for the next two, which is unusual or infrequent item and change in estimates. If you see here, both of them are adjusted inside an income statement, and both of them are adjusted pre-tax, which means we are not gonna subtract any tax from their amount. If it is a gain or if it is a loss, we will directly write the original amount actually or shift it to the income statement. So let's do this one. So in this one example, I'm gonna teach you how to adjust unusual or infrequent item, and along with that I will also use the example of change in estimate also. So like we have a one scenario for both of the adjustment together actually. So once again, in order to save time, you can see that I have already prepared an income statement for you people actually. The same figures are there, like accounts are there: sales, cost of goods sold, gross profit, selling expense, admin expenses. We got EBIT, rental revenue, interest expense, and then we got EBT, tax expense, and net income actually. Now you may wonder that why I have left such a big space here. The reason of leaving a space here is because of these two adjustments. Now, as the adjustments earlier, we said that it is in the income statement. So yes, we have an income statement in front of us, but it is a pre-tax income statement, which means like no deduction of tax would be there. So it's like it would be adjusted before the subtraction of the tax. So if I see here, I have a tax subtraction line here. So what I'm going to do is that if whenever I see a pre-tax word here, so they will be adjusted before, like in this region, before the tax is subtracted actually. So I'm going to utilize this place here. Now, ladies and gentlemen, look at this place. It is after EBIT and before EBT. So it's kind of a sandwich of these, okay? After EBIT and before EBT, whenever you have unusual, infrequent item or change in estimate, you're gonna actually adjust them in between these two names, EBT, EBIT, and EBT. You're gonna adjust them here in this region, okay? Here, under the heading of others actually. So let's say we had a loss in the inventory value due to damage, okay? So I can write it here like it's a loss, so I will write here minus. If it is a gain, I'm going to write here plus, and likewise plus and minus will be done. Or maybe my organization considered that they have just came to know that they have lost some value due to the currency translation, okay? And this translation is something which is not very usual for my company. It's kind of like an infrequent item, okay? But so we can write it like here. Or let's say there is an earthquake, and that earthquake is a very common thing in our country. So I had a loss due to earthquake, so I can write it here, loss because of earthquake. Gain, capital gain because of this. So if it is a gain. If it is a loss here. So let me write a couple of accounts here so that you can get an idea. Let's say I had a loss due to earthquake. So let's say if we classify earthquake as our unusual or infrequent item, and now you have already studied my basic understanding or the basic discussion on what actually these items mean from the PPT. So I will not discuss that here, but you do know that why I'm writing loss due to earthquake here. So if it is a loss, I will directly write the amount of money here. Okay, if you see here, I have not written here any tax adjustment like this. I used to write loss in a sub column and then tax adjustment, and then the total was shifted to the main column. Here there is nothing like this. Why? Because of this reason, pre-tax. Okay, so this is one example. Okay, now if this is the example of the unusual or infrequent item. So let's say if I had a gain, so I will write here plus gain due to currency. Okay, currency translation, let's say. So I can plus it here. So these are the examples of the unusual or infrequent item. Ladies and gentlemen, for change in estimate, let's say I had a I estimated that let's say $2,000 of my account receivables will not be recovered. So that was a bad debt. Now I have estimated that, okay, $2,000 was estimation in the previous year. This year I expect, let's say 1,000 more I will not be able to recover. So then that's kind of a loss actually. So I will write here minus, and then I will write here that loss due to uncollectible, or you can say bad debt expenses. Why? Because my estimation has changed. I estimated previously that 2,000, now it's 1,000 more. So I will only write here like 1,000, not the complete 2,000 here. Is it okay? Not the 2,000, 1,000 only, because that is the change in my estimate. The change is how much? From 2,000 I have shifted to 3,000. So how much is the change? 1,000. So that's how you will adjust it here. And then once you have it, then obviously you're going to plus and minus according to this to the EBIT. You will get the EBT figure, and for the tax expense, everything remains same. The only thing is this region where I have actually just discussed the unusual and change in estimate. So let me highlight it for you people, okay, and then you can get a clear idea of the place. Okay, so I have highlighted the portion actually. So if you see here, in the previous questions, actually it was like below the net income adjustments in the discontinued and extraordinary, and if you see here, like it's now within the income statement. It's kind of a sandwich type of an adjustment here we have for unusual and infrequent item actually. Okay, so this is the place where you will adjust it. Remember the names, that after EBIT and before EBT, this is that region, the sandwich region, where you're going to adjust these two special or irregular items actually. Okay, so this was the third one and the fourth one. So we are done with the four. Actually, let's go for the last two. Now if you see in the last two are actually adjusted in the retained earnings statements, not in the income statement, but their adjustments is kind of like net of tax, which means I will subtract taxes actually. So let's go for this. This is the adjustment session of the, or page of the error and omission. And the next one, the last one, is change in accounting principles. So I'm going to like adjust both of them together. Now you see here a sample of retained earnings statement where we write the name of the company, retained earnings statement, and for the period ended, like the year ended 2020, let's say. Then we always write here beginning retained earning balance, that whatever the retained earning balance was from shifted from the previous year to this year, this will be the start of the year actually, 1st January. Okay, then let's suppose that there is no empty space here for time being actually. So if there is no empty space or there is no adjustment needed actually, so right after this line I'm going to write this line here, that okay, the adjusted balance on 1st January 2020 was this much, and then during the year 2020 we had a net income, so I will plus whatever we have earned with this thing, because if I earn, that gonna increase my equity. But if there is a loss, then I gonna subtract it, because this will decrease my equity actually. And then if any dividend is paid to the shareholders, so obviously that gonna be subtracted here. Okay, so that's the retained earning, plus if more profits are earned, minus if dividend is paid, and whatever is left over is actually called as the ending retained earning balance as of 31st December, like the last day. So that's the first day of the year, this is the last day of the year. Now that if I have these two what you can say irregular items present in my numerical or in real life with me, you do know from my previous videos and recordings that what actually they mean. So I'm not focusing on what is the meaning of this here, okay? So if you do have these two irregular items, what you're gonna do is that this is the place here, right after beginning balance. Remember it, okay? Right after writing the beginning balance, okay, and before this adjusted balance of 1st January, this is that place where you're gonna do the adjustment here. So let's say we mistakenly forgot to record depreciation in the previous year, and this year we realized that, oh, I did a mistake, I forgot it. So what you can do is that's kind of an error and omission mistake, so you can adjust yourself here. Now depreciation should have been recorded. It means it should have been subtracted. If I am adjusting here, so I will subtract it here also. So like minus, okay, it could be plus and minus adjustment. Now both adjustments could be there. So I will like write it here. You can say depreciation omitted in year, let's say 2019. So how much depreciation was omitted? Let's assume we omitted $50,000 worth of depreciation by mistake. We were unable to like record it. So it's kind of a minus. And then if you remember the basic table, that net of tax, it would be, so it means we're gonna subtract the tax, so do the tax adjustment. So just like discontinued and extraordinary item, I will write here tax adjustment here exactly the same way, okay? And in our country tax is 20%, so 20% of $50,000, I believe it is $10,000 tax adjustments, and the remainder that we get would be $40,000. And as it is kind of a minus in nature, so I will write here minus. Is it okay? Let's say what my company did was that they changed the inventory method of LIFO to FIFO, okay? And because of that, changing the inventory method from LIFO to FIFO, we had gains, okay? So if we have gains, then I will write it here, gain due to change in accounting principle. How much gain we had? Let's say we had $100,000 gain actually. So again, if you see the change in accounting principle, net of tax, so I had to adjust the tax value here. So that would be tax adjustment. The tax adjustment is 20% in our country, so that's like this much, and you get the value here, $80,000 positive value, because this is a gain. So we got a beginning value plus 80,000 minus 40,000, and then we get a remainder here. This remainder is called the adjusted balance, but at the start of the year. Then during the year, from 1st January till 31st December, we did business, and because of that business we created income. So I will plus it here. If it was loss, I will minus it. And then during the year, I decided to give dividend to shareholders also. So if it is, then I'm gonna subtract it, and the remainder would be called as the ending balance, which will be shifted to the balance sheet actually at the end of the year. So ladies and gentlemen, actually what we did was that we did 6 adjustments here, 1, 2, and then this was the 3, 4 actually, and then we had like 5 and 6. Okay, so these were the 6 special